Welcome back to the show, everyone. Saeed already in the chats. What's up, brother? Took me approximately 4 minutes to get a live show up and running. So let's see how we do today, given the fact that this used to take me like 30 minutes to get started. Now it takes me like no time at all. I blame AI for that. Welcome back to the Higher Standard Live. I am your host, Chris Nahibi. I'm one of two hosts. Saeed Omar joins me on the main show, which you likely already know us from. That's where most of our viewers coming from. If you're watching us on the vertical format, the stream is sexier in horizontal, as most things in life are. You can catch that on LinkedIn and X, as well as on YouTube during the live stream. However, we figured out a long time ago that the YouTube algorithm does not reward sexiness in long format, particularly podcasts, because they look at retention rates, and retention rates on a 10-minute video being watched for 5 minutes is 50%, versus watching this for 20 minutes is less than that. So let me tell you, we pull those off the interwebs, and it breaks my heart every single time because I think this is there's some value in this product, and I think it's meaningful to put it as a date down. But that is what it is. This show is lovingly brought to you by the team over at Fridays. You can go to joinfridays.com. Enter code HIGHER, you get $100 off your first order. They sell everything from GLP-1s to longevity medication. I take NAD+. Lots of fun, interesting products there to help your health and overall well-being, and I find it to be a sensational product. Particularly if you can do the injectable kind. They do have the nasal spray kind, but I like the injectable personally for the NAD and the overall health benefits. I do feel younger and more alert on it, but that's just me, and maybe it's placebo. But hey, you know what? Don't lie to me. I feel like it's okay. That's the start of the show, kids. And the market, well, it's been a little volatile. And if you've been watching anything that we've been saying for the last several weeks, volatility is kind of the new name of the game. So much so, we actually reworked our synthetic volatility index, and that model has been reworked such that the end result will be more in line with what I think is the spread of volatility over time. It's kind of a sad silver lining to the rainbow of the economy that we're in currently, is that it allowed me to test the models we've rolled out for this show in both a positive climate and now a very drastic climate. So with no further ado, let's get into the market status, shall we, kids? It is continuing to be defensive. We are hiding in safety, as you see up here. Dow's down, S&P, NASDAQ, Russell, and the QQQ are all down on the day. We're in a defensive position. And I think a lot of what happened yesterday was part of the rhetoric that I think you can kind of expect to see that's driving some of this narrative. The market wants positive news. Humans innately want the positivity so that we can find a way to grow and invest and structure things. And because, well, we're not getting that, and there's a lot of disinformation out there, I think the confusion is causing even more volatility than what would otherwise be there. And what am I talking about? Well, yesterday, if you were watching the news, the Secretary of Energy comes out and says that they have escorted the first oil tanker through the Strait of Hormuz. Well, 5 minutes later, that tweet is now gone, and the White House denies it. As a matter of fact, takes an opposite stance. And you heard just shortly after that that Iran was then taking mines and putting them out into the waters. These aren't just mines like, like a minefield, like a big round thing that's floating. These are AI driven, like powered, think of them as like mini submarines with explosives on them. So these are real problems for the Strait. And the idea of this ending in like a day or two, well, that's seemingly not happening. There's going to continue to be more conversation. And over here to this side of my screen here, I have CNBC going at all times, and I've got CNN over there going at all times. So I've got all sorts of the spectrum. And I can tell you that this is not going to end anytime soon. At least not in the days that some people thought leading up to it. It's going to be weeks at the very least, is my most likely guess, based on what we're seeing. Now, the 10-year Treasury doesn't like this. Volatility is scary. So you see the 10-year spike up to, I want to say, 420. We'll look at that here shortly. But volatility is not good for the market. And going to the status here, hiding in safety, defensive positions. Well, let's look at synthetic volatility. This has actually improved a little bit. The implied volatility really is driven by the VIX or the VIXC here. We got a tense environment, but everything else in the economy is kind of fighting back a little bit. And I'm going to continue to take screenshots of these. So if you see me put my head down and take a screenshot through the show, this is just me taking a date down of the model, because I want to make sure that what I'm capturing is actually working, because we're going to roll out a beta platform, which is going to help us all trade and do some really sexy things in the future. But for right now, volatility appears to be just into the normal range, actually almost into the calm range, despite the fact that the market is in a bit of a sell-off. Now, this is not a panicked or unstable sell-off. It seems to be a very pragmatic and thoughtful sell-off in the markets, which is not what we saw in the last couple of days. This is people, I think, settling into the ideology that this war and the volatility is here to stay for a prolonged period of time. And I think that's going to continue to be just a driver until such time as things happen. Now, I should be very candid here. The volatility in the market is here to stay. And that means headline risk is going to swing the markets massively on some days. And as that happens, you need to be cognitively aware of what likely could happen intraday. These headlines will come out and they'll move the needle like this, just super quick. Let's go to the VIX real quick. This is the VIX. We're still elevated above 20, and I can tell you that right now that to me signals a little bit of an improvement over the last couple of days, which our model is also signaling here. And I'm going to go ahead and pull this up here, go to the one-day chart and make it real big. There you go. This is the CBOE volatility index. This is the fear gauge that everybody always talks about, and you can see the volatility in the fear, right? I mean, that's volatility at its most basic, obvious, up and down visual example. All right, and that is not good. So to give you an idea, you got 24 down here, you got 25 up here. So you're seeing it kind of waffle up and down, what I would call heightened volatility. Again, anything above 20 in my mind is something that is a volatile or more scared or tense economy. Now, this is certainly not what we've seen over the course of the last several years. For example, we saw it get up to 52 here back in April of 2025. Let's go to the 5-year. That was the highest it had ever gotten. The highest prior to that were 2022. This is, again, pandemic era. 10/10/2022 was at 32. We saw it at 33 in 4/25/2022, and we saw it at 31.98 in 2/28/2022. So certainly this was an outlier. So if you remove the statistical outlier of this 50-something number, these getting to the 30s is really concerning. And that just goes to show you how far off we are from the 30 mark, if that makes sense. Let's go to all time just for one more perspective here, which I think is valuable. These are the all-time highs. Let's go to 2008. The height of the great financial crisis opened at 39. High of the day was 57, and it closed at 44. So again, here's another one in 2011, which this is June 2011. Closed at 442, opened at 16, high of 48. So you can see we're not anywhere near all-time highs right now. If you look at this chart here, we're not anywhere near that, but we are certainly in a heightened fear-based economy. And our synthetic volatility index is not supposed to be driven off of that ideology in and of itself. It's supposed to be driven off of how is particularly the ETFs and the derivative trading reacting and showing here. We have some comments I'm going to address early on. We got Said here in the comments section. Bonds logged their biggest sell-off in 9 months once the war started. Historically, when war breaks out, investors rush to bonds, causing them to go up and interest rates to go down. This can't be good. I would agree that it can't be good, but I would also say there's some other motivating factors for this. There is something to be said for Ray Dalio and his comment that we are going off of, we are changing from the current world order to a different world order. And I think that we saw a lot of that activity happen between Russia, between China, and going off of the dollar. The petrodollar here is going to be an interesting conversation as time goes by. Hugh, what's up, brother? Over on LinkedIn. Are these swings the result of algorithms or are they real retail day traders? And that's a great question, dude. And so this is one of those things where philosophically, I don't think anybody really knows 100% sure. I think we all have our underlying feelings on this. I will tell you what I do here. So grain of salt, I'm a moron. This is the reason that we like to look at for market status. And I'm going to go ahead and take your comment down so I can show you here. For the market status, we don't look at the indices because they carve out some of the derivative-based trading. So we look at, for example, the ETFs here as proxies for the actual indices. And they also have less interruption if the indices tradings halt because the ETFs are still there. But that's why we look at those. We want to see real activity. So I want to include real cash flows and real derivative trading versus looking at, call it just retail in and of itself. But I also think you cannot deny the impacts of retail here as well as the algorithms. Jane Street's a great example of this in algorithmic trading, impacting the market in real meaningful ways with Bitcoin as a proxy for the stock market, the equities market. Jane Street every morning at 10 a.m. was moving such an amount of volume algorithmically that it dropped the price of Bitcoin every single day, and it became known, or every single 10 a.m. It was dropping, and that became an algorithmic thing that was just happening. I don't think it was malicious or intentional, or at least it seems not to be. We'll find out as that litigation continues. Michael Saylor, I think, amongst other people, are suing them. But certainly, I think there's algorithms that are involved in this because there's always downside benefit. There's the retail side. And then here's the other thing, Hugh, that I think is really interesting is I have an AI agent here now in the studio that I have been working with because I want to stay abreast of agentic AI and how its implications to the workforce are. I obviously still use LLMs and I use AI on the show, and we're going to use some of that for the behavioral segment coming up. But what I can also tell you is now, before, let's go to the side here. Before you had retail, right? You had retail over here, right? And then you had the institutions over here. And the institutions drove so much volume that these guys really controlled the market. And they still do, but with the democratization, to borrow Vlad over at Robinhood's language here, retail cannot be ignored. And you need to look no farther than GameStop and some of the retail trades that we saw where these chat forums and these groups can put together and almost crowd fund institutional like influence in the market. And these narratives, the behavioral economics kicks up. So much so that we have felt on this show that this is a huge component of why we cover what we do in the show. And I think this is what differentiates us from someone like CNBC. CNBC will give you their narrative. They will cover once the retail rhetoric gets driven so high that it actually moves the market. And the institutional people have their hands in the pot of somebody like CNBC. But that's why we have our XAI behavioral economics portion of the alpha model that we're building. It's because I do think that there is something to be said for algorithms and there is something to be said for retail. And I really think that, to your point, that are these a result of algorithms or these a result of trading? I think it's a little bit of both. I think that what happened on Monday post initial war start was clearly driven intentionally, not algorithmically, but by people trying to prop the market up so they can get their money out at highs and move money around. And then the subsequent fallout we saw afterward, I think, was driven by the natural algorithmic trading that was going to occur. I think algorithms are being weaponized to keep the market up, not down, frankly, but that's another conversation for another day. Oh, my friends, face turquoise covering eyes. What? Is there like an image attached to that? Because I can't see it if there is, but I like the visual of the description. What's up? Omar, Said Omar, let's see what we got here. Tinfoil hat time? Yeah. Tinfoil hat cap on. Feels like the swings are becoming more frequent and almost deliberate, conditioning us investors to trust short-term headlines less, instead focus on long-term investing. Yeah, so, okay, let's run through that. That's a great point. It used to be that the American dream was life, liberty, pursuit of happiness. Pursuit of happiness was home ownership, and home ownership has largely gone by the wayside. But if you do look at the charts and you look at equity appreciation over time over the last, let's just say 10 years as a, kind of a microcosm versus the last 10 years in the stock market has outperformed by a multiple of 10 in some cases, your home equity appreciation. So in some world, granted, grain of salt, homes, we all have to live. In some worlds, it made a whole lot more sense for people to invest in the stock market if they were disciplined and consistent enough to match what they would have done in their home and they had the money versus buying a down payment in a home. They could have, in theory, made more money in the stock market. But the stock market, we used to have an ideology, which we covered on the show, which I think Saeed is alluding to, where you had people go 60% into equities and 40% into bonds. That was the traditional long-term savers route to wealth. Well, I don't know that necessarily applies anymore. So much that we covered in the show an 80%, 20% split with QQQ, top 100 performing stocks, and Bitcoin, BTC, as a possible alternative to what otherwise was the historical legacy model. I think the American dream is changing. And I also think that a lot of what we're seeing from an investment perspective needs more thought. You've got poly markets, prediction markets, which didn't exist. You've got home ownership out of reach for most people. We're going to cover that in the affordability model. You've got a lot of changing dynamics in the landscape. And it's really, really hard for us as a culture to get away from the old wives' tales. Not only do people not understand finance, but let's look at it in the fitness perspective. Butter is bad. Carbs are good. Well, it naturally fed the grain industry in the United States for a long period of time. We now know that carbs aren't necessarily bad or good, but different ways of losing weight work for different people. There's cheat codes like GLP-1s, for example. Shout out to Fridays, joinfridays.com, use code HIGHER. But there's different ways to do it, and there's different ways that are functional for every single person. So you don't have to be in the world's greatest shape, but there's different paths to get to better shape that work better for different people. Certain diets work better for some, certain diets work better for others. And there's no difference there between that and finance, truthfully. What that really means is at the end of the day, as long as you adopt a methodology that you believe in that works for you, you're good. The problem is most people are too afraid to take the leap in to start making the investment and choosing whether they're going to be conditioned with that old outdated logic or they're going to build their own logic and find what works for them. The same way you got to play with diets for your body and workouts for your body, you got to play with investment strategies for your life, whether that's investing in stocks and real estate and whichever one you pick. I love real estate, still do. Kicks my ass some days, but I'm still heavier in real estate than I am in the stock market. Just a grain of salt there. Let's see here. Keeping capital committed to the market for longer periods. Yeah, that could be. All my friends. Love that name. It just seems like everything is just curated to satiate the masses, but benefit the ultra rich insiders, conspiratorial, or maybe not. Yeah, it does feel that way. 100% it does feel that way. Sai and I talk about this a lot of times off the air. We get very discouraged in moments because there are things that we have seen personally, particularly me at my level in the public traded markets that I've seen that I can tell you it is manipulated. That the paradigm is shifting, that things are wrong, 100%. And now we have more visibility than ever thanks to social media and the cadence with which news travels and the speed. It goes like this. You don't have to wait for printing presses. You don't have to wait for rumors and gossip. You get it, boom, right on social media almost immediately. And if you're the energy department, that could work against you if you put out a statement too soon. But certainly, yeah, it feels that way because it is in part that way. And you need to look no further than the Epstein files. If you are in denial that there is a completely different elite class system, then I don't know I don't know how I could convince you otherwise, other than the literally millions of documents that hit the internet that show a lot of interconnected people doing a lot of bad things that don't seem to be held to the same repercussions that you, myself, or anybody else would be held to, frankly. And I'm gonna leave it at that for context, and you can read into the innuendo all you want. Let's get over to liquidity. Liquidity Pulse Index has also been updated along with Silicon Valley, see where my head's at, with the Synthetic Volatility Index. This is the current Fed balance sheet. We still have a supportive Fed balance sheet. Bank reserves are good. Treasury accounts good. Net liquidity level is still a drain. So until that improves, we start seeing some flooding. We're going to wind up being a little bit in the tense window there. And then we'll hopefully get back up to supportive and flood. But I don't think there's going to be any major moves here until such time as we figure out what the war's impact will be. We've got a Fed meeting on March 18th, which does lead me to the calendar here. Let's spend some time looking at that. I don't think the Fed's going to make a lot of moves going into this. They typically hold during wartime events, but you got the 30-year mortgage rate today. Core inflation rate today, which I haven't checked because I got here to the studio a little late. Initial jobless claims. But then next week, this is the big one right there. Next Wednesday, the 18th, that's the FOMC rate decision. Now, I don't think there's going to be anything meaningful that comes of it, but I think what you will get from that particular conversation will be dialogue from the FOMC on their perspective on how they're going to react to the war. I think you're going to see the FOMC get, particularly Jerome Powell, get pinged in the press conference. Hey, all this stuff's going on in Iran. Like, what do you think? And how are you looking at it? What are your thoughts? You'll get some of his color. And for those of you going like, hey, Chris, there could still be a rate cut. No, there couldn't. This is the Chicago Mercantile Exchange Fed Now watch tool. It is right there. That is your probability of no rate change. That is a 99.4% chance of getting no rate cut on the 18th at the FOMC press conference. So just full disclosure, there is a 0.6 probability, 0.6 of cutting 25 basis points, and there is no probability of a rate increase at this time. So that is about as certain as you're going to get that there will not, in fact, be a rate cut. It is a foregone conclusion. The value, the meat and potatoes of that dialogue will be what the FOMC, particularly Jerome Powell, says during that. And we are nearing the end of his tenure as the chair of the FOMC. So certainly there's going to be some forward-looking and some conversation about Myron and about some of the other more aggressive FOMC members, as it pertains to their voting synergies with someone like Ward, who should he get the nomination? He got the nomination, but should he get the confirmation? That'll be an interesting dynamic there. Let's go over to the housing affordability. This continues to be stretched. We've seen some slight improvement, but nothing that's meaningful here. Supply constraint is what it is. Not really a whole lot of change there. These are your Q4 2025 numbers, which, believe it or not, are the last from the St. Louis Fed. Mortgage rate pressure seems to have been unchanged. I'm going to spend a little bit less time on this today so we can spend a little more time in the sectors. Housing down, rate sensitive demand, and rates are they're going up, kids. We've seen some volatility in the rate market. Volatility is going to be a buzzword here. Let's give you an overall market status before we go too much into this from CNBC. Again, I show you this because I think a lot of you could benefit from just doing this on a daily basis, just once. Even if you don't want to watch the news, just get in there, take a look at this real quick, and you jump in. Shout out to all my friends over on the Instagrams How you doing? If there's anything you guys want to see, my sister out there, how you doing? Temporary pain for long-term gain. That is right, Rosie. And you know what? I think more temporary pain is likely to come based on what I'm seeing in the data so far. So I think that's a real thing. Sai, you are everywhere, brother. You're over here too. I feel like if I watch X more frequently, I might become a successful day trader. X has got a lot of disinformation, and I can tell you that one of the things that I typically do is if on X they cite a source and give you an article, I will read the article. It is not uncommon to see somebody parse out pieces of articles to pitch a narrative. So you got to be very, very careful on X. It's a wonderfully free platform, meaning that people can say and do whatever they want without the same limits. And as somebody who's in the social sphere, like Saeed and the rest of the team and I are, I can tell you that like posting on YouTube has got a lot of restraints. You can't be as free as you want to be. On X, I can say and do anything I want, which is also again part of the algorithmic reason we don't leave these live shows on YouTube. It's a wild, wild world. Sarcasm? What? Sarcasm, Rosie. We don't do sarcasm here. You know I have no personality. Dow Jones is down 356 points in the day. That is not surprising at all based on the kind of flippant comments that we saw yesterday. But more importantly, this is the one-day chart. You see it start up here, session high, and it's kind of coming close to session lows. We are seeing this trend down, not up. I think in a lot of markets, what you typically see is you see this start low and then trend higher as the market gets a little bit more calm. This, to me, to Hugh's point, signals that the algorithm and the people that are trading algorithmically are starting to understand that this is going to have some longer pain points. And because of that, they're pricing in the pain now. And the Dow Jones is coming off that. This could change if, somebody in the AI space comes out and says something that's very tech focused. But the U.S. deficit, topping $1 trillion in February, it's scary. S&P 500 also down on the day, and if we look at the one-day chart here, you're going to see something very similar in its cadence here. Started off higher and is now moving lower through the day as opposed to starting off low and moving higher through the day. So again, this to me signals the market is starting to accept the reality that war could go on for a prolonged period of time and that there will be some headline volatility risk in the future. NASDAQ won't be very different at all. Down incrementally. Again, NASDAQ is very heavy in the tech space, but very similar trend here. Started off higher, near session lows already. So we're not seeing anybody break from that yet. And here we are at 11:30. The trading day ends about at 1 p.m. Pacific time. So not a whole lot of time left in the day. Anecdotally, that's why we do the show when we do it, right? I know it's inconvenient for a lot of you who are watching going like, okay, why does he do it at 11 o'clock? Like I can't watch it, I'm at work. Yeah, CNBC goes all day long. It's on every major airport, every major platform. There's lots of other platforms that do that. We like to give you an hour-long snapshot between 11 and 12, which gives you about an hour left of the trading day if you're going to actively trade no matter where you are in the markets. But it also encapsulates everything that happened in the morning up to that 11 a.m. time with the rhetoric that we have. So that combined structure gives you some action items you can still take during the day. If you walk away from the show and say, hey, I'm going to put my money X, Y, and Z here, and there, you got about an hour of active trading left to do that. So we're trying to be thoughtful about your money and your time as much as we are about kind of the overall circumstances of the market any given day, if that makes sense to you. So I do note this is an awkward time per se, but it's also the same time that I selfishly look at the markets myself throughout the day. A couple of other market items I want to look at real quick, I think that are worthwhile to share. Let's go into the crypto space. Bitcoin is back above 70. Shout out to Saeed over there. There it is right there, 70,800. So we've seen some pretty significant healthy movement there over the course of the last 5 days. You've seen it creep back up, and that could be the Jane Street pressure coming off. That could be more people believing in it, but certainly it is not quite acting as a hedge against inflation like I think people thought it was going to be. Gold has been the outspoken truth for a lot of what's going on here. That run-up has been crazy. All-time high, I think, if you look at it here, that's gold over the history of gold in perspective. I want to make this real nice and big just to rub in how disgusting this is. My wife sells jewelry. She sells jewelry on whatnot, vintage jewelry, everything from cosmetic stuff to real stuff, and a lot of it's gold. So for me, yay. But there you go. That's this is gold where it started, where it's been, right? If that was your investment account, you'd be very happy. But gold is increasingly more money. Now, this standard with gold is going to absolutely be impactful to some of the analysis that we're going to look at over time, particularly as a recession signal. And while I'm on that topic, let's see if I can find that recession signal for you, and we can bring it up now. I'm testing some stuff in the back end with an agentic AI bot that I've built, and I think it's really fascinating to share. But let's see if I can find Dow Jones to gold historical ratio. You guys ready? I'll pull that chart over here real quick. I'm going to go ahead and let's take this over here. We'll clear this off a little bit. Let's go over to this view. All right, so the Dow Jones to gold ratio has only fallen below this level 4 times in history. Notice that gold is at an all-time high, so a grain of salt here. But I want to point out some things that I saw yesterday, which are fascinating. If this chart is overwhelming, don't worry. We're going to get there, okay? The 4 times the Dow Jones to gold ratio have dipped to the numbers that they're at currently. 1929, the Great Depression. October 29th, 1929, I have on my wall in my house a newspaper from October 30th, 1929, showing all positive headlines talking about market recovery. I had that as a reminder, even in the worst of times, the next day can be a positive outlook. It's a choice that we make. It's also one that happens to sell the stock market the way the investors wanted to at that point in time. But 1929, right there, boom. 1973, another recessionary economy. 2008, great financial crisis. 2026 today. Okay. And just to be clear, hyperinflation, by the way, right there. But these are for monumentally economic recessionary periods of time. These are not small blips. These are massive, massive happenings. And this is not a fortune telling proxy. But if this, so I'm gonna do this here in a little bit more visual way. 1929 up, 1929 down. Okay. 1973 up, 1973 down. 2008 up, 2008 down. 2008 was pretty painful. 2026 up, a little flat. That's your prolonged period of economic prosperity with artificial interest rate deflation. We didn't see that anywhere else in this chart, and now we're starting to kind of head down this way. What do you want to bet? This down looks a little bit more like that over time. I don't know if that far before it creeps back up. That is some of the data that I think a lot of the pundits of, hey, we can't have a recessionary economy or a stagflationary economy, which I could argue we're in now, are trying to say. I think this chart shows you that the reason why you hear this rhetoric is not because people are doom porning you with email and you know these newsletters and their fears and they're scrolling on the social platforms. It's because there is meaningful tactile data here, which seems to suggest that there's a problem. Now, I understand this is a 125-year Dow Jones chart. I understand that you could take data anyway and you could do something like this and go, look at all these trends. See? If you follow this line, that line, this line, that line. It's not that, okay? I'm not saying that we're on the precipice of an economic fallout. I'm just saying that there certainly is some data which seems to suggest that we are at an economic height and that coming down off that economic height, whether that's a correction of 20% or less, an adjustment, whatever you want to call it, 10%, 20%, we need some type of change in the markets. I think the war here, whether you like it or not, may be that catalyst. As ugly as that fact and truth may be, it could be a reality. So I think that's something that we have to consider as a reality as we move forward here. Let's get into the sectors a little bit before I actually, Said, did you make a comment? There you go. Yeah, I knew this was coming at some point in time. We probably should talk about this one on the show, the de-dollarization conversation. De-dollarization is a process and not an event. I expect gold to continue to climb. Beijing's treasury holdings hit a September low. Yeah. So this goes back to 1971, going off the gold standard. And then there's been a lot of events along the way. China and Beijing going and changing things. There were some petrodollar conversations. There was certainly some dialogue with Russia and China recently about trading away from the dollar well before the war broke out. There's a lot of international things happening. It's part of the reason why I continue to reference Ray Dalio's position on the New World Order. The United States, which I love, it's my country, I was born here, I'm all about it, has been a world power, arguably the world power for a prolonged period of time. Longer than most modern countries have been. Now, I say countries because if you're into archaeology and history like I am, there are entire civilizations that lasted hundreds of, if not thousands of years. But they did so without, at least seemingly without the knowledge of other civilizations and other parts of the world. And if not the knowledge, they certainly didn't have constant communication the way we are all tapped into one another. At some point in time, we have to become one unified culture of people and stop these arguments over silly borders. But until such time as we, transcend to a better place as a species, we're going to argue over stupid shit. And that's what we do. We argue over stupid, nonsensical things. and we go to war over it, and we get greedy, and we try to take things. And because of that, stuff like this happens, right? We manipulate currency, which impacts other people, which impacts other things. Look at the Iranian war right now. The Iranians are clearly cognitively aware of the impacts to the market. They've made comments to that effect. They are waging a war as much fiscally as they are physically, and I want people to think that through. A lot of the things I think people are expecting like terrorism and bombs domestically, but they can do a lot more damage to the United States by destroying the economy. And I think that's part of what the Strait of Hormuz conversation really is about there, is I think they figured out they can control the economic damage a lot easier than they can control the impacts of a physiological war, particularly one that isn't gone boots on the ground yet, which frankly is the only way to liberate a country, but neither here nor there. Let's see, lots of comments over here in the side. Check Instagram out a little bit. Rosary, Saeed and Rosie having a whole lot of conversation over here. Small speculation portion of the portfolio. Me too, just about 5% for now. Good for you. I like the speculation portfolio. You know what I do is I still do this in, I know I'm a terrible person. I still have a lot of my money in the VOO, Vanguard low cost index funds. I also have some emerging markets funds. There's a bunch of different V something funds that are out there. They're all low cost that I've invested in. I've got a bunch of different spreads there. But what I also do is I go, hey, you know what? I like this stock. I think this stock's great. I resonate with it. A great example of this is Apple, right? So I'll just buy Apple, right? And I just look at it as dollar cost averaging over time. I go, I like this stock. I'll go buy that one stock, and I'll just hold a small amount of that stock in my portfolio. And like that Apple stock, which I bought for like nothing, wound up being 10K pre-split. They split and wound up being like 20K, and I've held on to it for I think at this point almost decades, but. I like the product. I invested in. I go to Disneyland all the time with my wife, so I just go buy some Disney, right? I'll go buy some Disney right there. Boom, done. That's my speculative portion. I am starting to get back into the crypto sphere and doing a little bit more like that to try to get a little bit more mix of other riskier assets because I am a naturally inherently risk-averse person. Mr. Kyle Fox, didn't Ray Dalio say to have at least 15% of gold in your portfolio? He did. He's got some varying different answers to that in his book. If you read Principles, so that article that he published about the New World Order that just came out actually was just a chapter from his book Principles, which is a massive book. I listened to it on audio all the way back in the day. I'm actually due to listen to it again. So I think a lot of that rhetoric was going on. What people don't realize, he called that a long time ago. He's always been a believer as gold as a perceived hedge against inflation. We've said on the show that gold is not a hedge against inflation. The only hedge against inflation is to continue investing over time. But you cannot deny the metrics on what we just showed on gold. We're at an all-time high. It is a straight, vertical. And when something looks like that, and you're like, let's just do it again, just for shits and giggles. Here we go. That's your gold chart, right? This is why he says the whole 15% in gold. If you look at something on an intraday perspective, okay, this looks bad. You're like, oh shit, where do I buy? Where do I sell? But this is one day, okay? And Ray Dalio is not the guy who's going to algorithmically day trade when he tells you something like that. He's telling you to hold it because if the market tanks, you've got a hedge against the market's activity because people will naturally rush into gold. And as you start looking at this over time, even 3 months, you see you start to build a healthy trajectory here. 6 months, healthier trajectory. We're going to go year to date. Okay, you got some blips, sure, right? But if you're going to look at this as a 1 year, 5 year hold, the results are undeniable. And this is why people always talk about gold as being the place to be, right? If you're holding it for long term, this is where people lose focus. If you're holding it for the long term, gold is undeniable. And again, I go back to the all-time chart here. Yeah, sure. If you held gold and, sorry about that. You held gold and you were in this little valley here, you're like, shit, gold lost some money. Some money. But relative to everything else, you're talking $1,000 here. You're talking $2,000 here. So it didn't drop to zero. This is not cryptocurrency volatility. And you've seen a straight spike up, okay? That's a pretty big difference. And if you're saying, okay, well, Ray Dalio doesn't necessarily believe in cryptocurrency, yeah, I don't know that he hates it as much as he says he does. I think he's got a vested interest in that. But let's look at Bitcoin. And God, the Bitcoin bros are going to hate me for this. Don't take this personally. This is just me using facts here, okay? 1 year, okay? That's a much different visual picture, okay? I still believe in Bitcoin. I still believe in the blockchain. I still believe in tokenization. I still think there's a lot of value there, particularly for things that are outside the currency sphere. But here's the problem with cryptocurrency, right? You've seen a very similar run-up. Again, this is only going back to about 2010, 2011-ish. But you've had some massive dips. You're talking 25,000 to 75,000. So these dips are much more meaningful than what you saw in gold. So you're losing a lot more value in those valleys than you did in gold as an example. Now, if you look at this over the all time, I mean, you're still down from the all time peak, but the volatility has also been greater over time. So you could equally argue that this goes up and looks like this over time. So take it with a grain of salt. I think you have some money here, you have some money in gold. You pick what you're good at, what you feel strongly about, and you roll with that. If you're a crypto person, you're not a gold person, more power to you. Me personally, my wife's got a ton of gold, and I've become a gold investor without even knowing it. So thank you, honey. I love you so much. That's where that comes from. Let's go back into sectors real quick. I have the audiobook too. I plan on listening to it again. It is a long ass book, though, man. The first time I downloaded Ray Dalio's Principles, I downloaded the audio and I'm like, why is this so long? And then I physically saw the book and I'm like, well, that answers that question. It is a big ass book. So I would drive on my commute to work every day, like an hour there, an hour back. I'd listen to it on walks. I try to take a couple walks a day. And it took me a long ass time to get through it. I think the problem with that book, if you want my honest opinion, is there's so much information that is just so scattered. Because he talks about management. There's a whole section where he talks about how he put in a system in his company to have people rate everybody after the end of every single experience. So if we had a conversation, you would get off the conversation with me, and then you would go rate me, and then your bonus was predicated on how you were rated within the company. And Ray Dalio himself had a rating. Think of it as like an internal social network where you get visible ratings by your peers, which could be all sorts of HR problems depending on what stage you're in. But yeah, some fascinating stuff there. And you know what? Good for him for being ahead of the curve on some of this stuff. But I've also found him to be a little bit neurotic, if I'm being honest. And I respect it a great deal, but he doesn't have. He seems a little bit more paranoid, if you will, than someone like a Charlie Munger, may rest in peace, or a Warren Buffett, or even like a Jamie Dimon. Jamie Dimon's last statements that I've talked about at Davos was, "You got to live in the world you got," right? Which makes sense. Like a social credit score within the company. Yeah, that's what he did, Rosie. And it was kind of wild because when you think about that, like, it changes how you interact with people if you know your money is tied to the score, right? So if I have a score of 10 out of 10, I'm getting a much better portion of my bonus. Whereas if I have a score because I've been cranky half the time of 5.6, that impacts my bonus structure. The attitudes change a whole hell of a lot, right? I mean, at least in theory anyway, they should. And some of the stuff was happening behind the scenes. It's anonymous. So really fascinating. There's a lot of components. I don't know how it all plays into things, but certainly it was a really cool read back then, and I'm sure it's no different now. I think, well, he's left the company, doesn't really run the day to day, from what I understand. Let's get into a little bit of the sectors before and I'll do this quickly. Banking sector should be down too. Yeah, there we go. Banking sector's down. Credit conditions. I have a whole lot on this, which Said and I are going to cover on the show. We record either tonight or tomorrow. We'll record it for next Tuesday's drop. We're going to spend a lot of time in the private credit markets, particularly how I think this could be a canary in the coal mine. We're going to look a little bit about the Dow to the gold numbers for comparable of just economic recessionary trends. But we're going to cover a lot of this in this sector on that upcoming show if you're interested. CRE REITs are going to be down on the day. Again, the markets are all down, so this should not be a surprise as to how down they are. What you're looking for here is statistical outliers to see if there's any other reason why they could be down. Refinancing risk here, nothing really material and meaningful. Mega caps, yeah. Nvidia still up. Who knew, dude? But yeah, again, market leadership seems to be relatively light today. Consumers, again, down. Industrials, mixed feelings here, but again, nothing meaningfully up. Right, so it's a negligible day. Energy sector, yeah, that goes to show you. See, this is the behavioral part that he was talking about. Okay, the algorithms for a lot of these companies are noticing that these guys are off their numbers, and because of that, they're going to buy them now because they think that they're going to make more money post situations like this. I know that's crazy, but that's the way the market works, and you got to think about it in that perspective. And it's opportunistic. Here's ExxonMobil. Okay, that's an interesting day, right? This is the time where everything that's going on here. ExxonMobil's got the most exposure. Is it Exxon or Chevron? I think it's Chevron. Exxon has the most exposure to Venezuela. Let's look at this over the course of the 1 year chart here. There you go. 1 year, ExxonMobil's up 35%. Okay, that's crazy. Let's go to Chevron. CVX real quick. Let's take a look at them too, see where they're at. And survey says up 20%. Yeah. So look, we called energy. I called energy. I called banks, and I said that technology was going to continue to lead the way. And I also said that some REITs were going to do well. And we're seeing that in the tech space. I did not see this. I mean, this is really war-driven and single event types of circumstances, but certainly it's bonkers out there. You have my honest opinion, this might be a little bit overbought right now, and I think those prices might be a little high. The longer the war continues on, I think the higher these may ultimately go, because in theory, 80% of the oil, that a little more than 80% of the oil that's going through the Strait of Hormuz is going to the Asian markets. China is going to have to put together a deal with either Russia or the United States. We've now activated, and we haven't built an oil refinery in like 50 years. We've now activated crude oil refineries to handle the Venezuelan oil situation in Texas and in Louisiana, Houston in particular, I think. And because of that, we're going to see domestic production increase. And in theory, because of everything that's going on through the Strait of Hormuz, these companies should see more demand because of that shortage on a national basis. Put your tinfoil hats on, do with that what you will, but it's led the stock prices going higher. And it's something that we did call. I do think the energy sector, as opposed to electric and power, is going to continue to grow. I've yet to hear how the new presidential decree is going to be enforced, because it is not a federal regulation. It's just a program everybody bought in to keep rates down and for the tech companies to pay for their own power usage. So that remains to be seen. Let's finish up the sectors real quick, get to some XAI, all the sexy stuff, because all the trash talking is always good. Let's go to the defensive stocks. And I'll bring you back over to the sectors. We've always felt that these are the preservation mechanisms. This is where I go, okay, if I'm looking at the status of the market and I see that people are hiding in safety, right? And the money's coming out, and I go, okay, and I look at synthetic volatility, but this is not hypersensitive. This is not people freaking out. This is strategic measured departures in hiding in safety. And then I go over here and I see capital preservation is not picked up, right? So we've not really truly gone risk off. We're just defensive, okay? We're really in that part of the wheelhouse. This, to me, looks like a strategic wait-and-see approach of the markets. That's what I think is happening here, is they're going to wait for headlines. They're going to wait to see a little more momentum. They're going to figure out where things are going, and the market is unsure. And unsure markets don't make moves right away, just like the Fed's not going to make moves right away. And if I go over here to the energy space, the market is sure about the overall net benefit to these companies. They are going to see a benefit, and that's why you're seeing them trade the way they do. This is also a proxy for geopolitical and supply risk issues. We are seeing geopolitical issues, and we do have some supply risk issues. So these algorithms and these sector analyses are working the way they're supposed to work. If you see people go risk off or into liquidation, you can absolutely bet that if a headline comes up and makes people freak out and go full risk off, this is where the money's going to go, right there. Okay, let's jump into the XAI portion of the show. This is our AI Claude Opus 4.6 driven model, where it scans the interwebs, pulls the most trending topics, give us its own insight. This is not my opinion. As a reminder here, number one topic should not be any surprise to anyone: Iran, Strait of Hormuz crisis. Iran has deployed mines in the Strait of Hormuz, prompting G7 coordination for oil reserve release and stopping escorts. And a number of people said that they weren't going to go, even if there is insurance that the U.S. is trying to pass through, just because they don't take the risk. FBI warns of potential retaliatory attacks on U.S. West Coast. First I heard of that. Shit. Despite crisis rhetoric, Iran's oil exports have actually increased 100K barrels, since the war began, suggesting supply disruption fears may be overblown. See, I don't know enough about the oil space to really believe that or not, but that's AI, and there's no bias there. If anybody knows the oil space, I used to have a friend back in the day whose dad was like an oil magistrate, and he just lived in the Middle East, and he just arranged transport of these giant containers, oil container ships. I would love to talk to him about his thoughts on this. I gotta find that guy and run him down, because that could be really beneficial. Number two topic: oil stock market correlation. Well, we're seeing it. We've been talking about it for the last hour. Oil prices have become the primary driver of equity markets, with the S&P showing a negative 0.6 correlation to WTI crude, the most negative since October. And of course, that does beg the question is what is WTI crude at right now? And I'm glad you asked because we're going to find out. It is up. It is not up to where it was before. Crude oil hit a high of just under 120, I want to say it was. We're at $87 a barrel. If you remember before all this really kicked off, I told people $3 to $5 at a minimum, certainly in the high 70s, and we have surpassed that as the wars continue to escalate. So we were also right on that call there. If we go here and look at where this is traded, this is 1 year. If we look at 1 day, which I think is more important, you can see the intraday trading. This is the session high. It is nearing session highs currently. If I look at the year to date, we are seeing a very similar uptick in pricing here, but this is also war driven. Most notably, this is March forward, and this is obviously when the war kicked off. Otherwise, I think you would have seen a much different trend here. It makes no sense to see this over $100 a barrel, at least based on what we've seen so far, but as we continue to see some paranoia that could happen. This is a reminder of the 5-year chart of what oil looks like with a spike over here, and this is where we are at today. So nowhere near historic highs. And just as a proxy, this is not gold, okay? This is not cryptocurrency, right? This is oil, okay? And oil generally doesn't spike up unless there is a supply chain or geopolitical risk issue, which is why the sectors that we built seem to show that. Venezuela was the first part of this. Interesting time, tinfoil hat conversation there to be had for sure. But that all happened leading into this. So until the geopolitical conflict settles, this is going to stay here and elevate or stay here and be flat. Each headline add to this will cause it to elevate. If we do have an oil tanker blowing up in the Midwest and it does get national headline in the Midwest, in the Middle East, then you're going to see this elevate more and more. But the rhetoric here that we're seeing on XAI seems to suggest that some of this rhetoric may be overblown in and of itself. Oracle earnings surge. They had I think it was a 44% earnings beat. Let's see here. Oracle stock jumps 8.62% following the earnings reported. A $553 billion backlog of accelerating OCI cloud growth despite negative free cash flow. God, the tech world is so strange these days. Massive backlog growth currently masks current cash flow concerns, but validates long-term cloud transition for patient investors. Translated loosely, if you're a patient investor, you have money in the stock. They're losing money right now on a cash flow basis, but they got a ton of work to get through. They'll figure out the logistics and they will make that money because they actually have orders they have to fulfill. Hence the backlog, which means they will make money in the future. So people are buying it for that upside potential, which they see coming when they do beat earnings after this backlog gets worked through, and they own the stock when it was where it's at. So that drives the price up, hoping that price will be less than the earnings beat price when they actually get through the backlog. That makes sense. There you go. Nike extended decline. I love Nike. This hurts my feelings, but Nike has not been innovative enough as of late. And I don't know that partnering with Kim Kardashian on Skims is a solution. Cool stuff, I guess, if you're a girl, but not appealing to their main core market. I would venture to guess that the overwhelming majority of Nike buyers are males between the ages of, call it, I don't know, 15 to 45 is my guess. But I'd love to see the demographic breakdown there. They seem to be catering towards women with the Skims line. Great, good for them. I don't know they've been innovative on the men's side of things like they have with the Skims product. So, and you got Nike CEO, which I believe is on Apple's board, and Apple's on their board, and there's a whole thing there. Tim Cook is, I should say. Nike's on track for its 9th consecutive red day, marking its longest losing streak since September of 2023. Yikes. Wow. I didn't even know that. Let's see here. Nike stock is NKE. Let's take a look at that. And it breaks my heart because I grew up. I'm a child who grew up with Nike, and I'm a big fan. So it breaks my heart to see it. But yeah, yeah, that's a 1-year chart, kids. Year to date. Let's just see how they've done so far this year to date. So yeah, it's been pretty ugly year to date. Let's look at the last 1 month. And well, yeah, not good. The inverse oil Nike trade, if you want that one. Jeez. Come on, Nike. Get it together, kids. Get it together. All right. So, yeah, Nike sucks. It's disappointing. Let's see what we got here. Extended losing streak often marks capitulation point. Nike consecutive red days may signal oversold condition for contrarian plays. So, this is one of the things that I've noticed that AI does when analyzing this stuff. And I don't know if it's a good or bad thing. AI tends to identify potential oversell, undersell behavioral economic trends. And because this is a AI social narrative driven feedback loop from, in this case, Instagram and X, it is telling you that it may be oversold, it may be undersold because it knows that this is behavioral driven, at least headline driven, because that's where it's reading and feeding us from. That is not investment advice. That's just one opinion from, frankly, AI. But certainly it is something to be thoughtful of. I do think that AI is right here. This is a bit oversold. Their earnings aren't cataclysmic. They do need some innovation. They do need some new leadership, frankly. They've lost some really good talent as of late, and their glory days seem in their past. But that could have been said for Apple at one period of time, too. If you got enough money and you got enough willingness to change and a good board, in which I think they do have, they will put the right people in place and make the right strategic changes to get the company back on track. My humble opinion, but neither here nor there, I guess, depending on that. I haven't checked the comments in a while. Who's still out there? Rosie, it'll settle by November. What'll settle by November? The war, you think? Or what are we talking about here? Like a social credit score within the company? Yeah, we covered that one already. Let's see what else we got over here. I haven't checked the other comments in a while. I'm a terrible host today, kids. You should fire me. Saeed, no comment in the YouTube chat anymore? Wow, bro. Look at this. Look at this dead chat over here. Let me see if I can pull it up here. There you go. Do you guys want to see that? Does that make you all feel like it's at all engaging? I don't like it being up on the screen as much as I can just pull it up here and pull up like ones that matter. But it's up to you guys. If you guys want to see more of it, we can certainly do that. I just I got mixed feelings about it. But here we are. All right, let's go out to the interwebs a little bit. Let's spend some time on the social stuff. You guys know I like looking at X, most notably because it's just a good thing that everybody seems to be doing all day long. And I think, oh, good Lord. That's a scary ass headline. You guys ready for it? Jesus. The FBI has warned police departments in California that Iran could launch a retaliatory attack on the U.S. West Coast using drones, per ABC News. Details include the alert said that the FBI recently acquired information of a potential surprise attack. Iran aspired to do this using unmanned aerial vehicles from an unidentified vessel off the coast. Targets are unspecified but expected to be in California. A spokeswoman for the FBI office in LA declined to comment. Oil prices are now plus 6% today. Wow. ABC News, same report. FBI, ABC News, same report. Jesus. Man. Home sales dropped. It should probably be worth saying I'm in California right now on the West Coast. Man. All right. Let's do one more, and then we'll call it a wrap for the day. It's pretty grim stuff, right? I mean, I can't be the only one who's just like emotionally just exhausted from all this, right? Like you see all this like headline press and negativity, and it's just a lot, man. Like it's just dark. It's grim stuff. All right, so according to Nick Gurley, home sales dropped to the lowest level since 2009, down from 35% from the pandemic peak and 25% from pre-pandemic norms. This was the second worst February reading in the last 30 years. Traditional news outlets tried to claim there was a recovery in demand in February 2026, but that obviously was false. Rather, buyers are on their biggest strike in U.S. history. The solution to bring them back is lower prices, not lower rates. I do tend to agree with Nick Gurley. There are a lot of people who disagree with him. I am not that guy. This is the home sales hit lowest level since 2009. And here you have your 2009 number there, and there is your lowest level there. Rates in and of itself are not going to solve this, okay? And I don't think you can go too much lower with rates without causing a bigger problem eventually. You can keep the can on the road, I guess. But look, the pundits get real pissed off when I say this. Yes, there's a housing supply issue, but the supply issue is not the problem. The value, the price, the cost of the home relative to wages, which is not kept up, is the problem. 3 different handles for this. Wages can go up, home prices can go down, supply can go up. We've seen the home builder permits, we've seen the construction starts, we've seen all that stuff. We've seen that new homes are cost less than existing homes, so there's no motivation for the home sellers to sell and build more homes to sell, and they're not building them. So that's the supply issue right there, number one. Wages are unlikely to be passed on to the consumer, keeping up in a meaningful way. You can only hope that wage growth outpaces inflation. And since when have you ever gone into your employer's office and they go, Bob, hey, man, you performed really well. We're going to give you more than a cost of living increase because we like you, Bob. We like you. That doesn't happen. So the only real lever to pull here is, well, technically in theory, a combination of all three would be ideal, but unlikely to happen, at least meaningfully on all three. Home prices have to come down. And I think you might get a new generation, new cohort of kids who say, look, I can make more money in the stock market. You're already seeing that on the social platform. Like every single one of these influencers, like, bro, why did you buy a home? Led by Grant Cardone, right? And I mean, say what you want. The math works in his favor. If you bought a home the last couple of years, you didn't make a whole lot of money. Now, he wants you to buy into his real estate investment funds and all sorts of other vehicles like that. The stock market, the equity market has outperformed home equity appreciation. So if you had the discipline and the patience to put your money into the stock market, you got rewarded heavier than buying a home anyway. So whatever will get some heads to turn for good reasons and bad. I totally agree. Sad. Yeah, sad day. All right, kids. Well, that's been a long show. That news kind of caught me off guard. That was I did not see that going into the show. Saeed and I were talking, and we've been busy doing a bunch of things. So that's just really disappointing. There's lots here about the leveraged markets. We're going to talk a whole lot about that in the not too distant future. Jeffrey Epstein, that's hilarious. So we'll spend some time talking about the private credit markets on the show that'll come out on Tuesday next week. If you haven't had any opportunity to connect with us, please do. Send us emails, talk to us, send us DMs. A lot of you respond the DMs. I've been responding a whole lot recently. I've been pushing the AI agent and doing my, kind of my day job stuff the last couple of days. So you might see some posting slow down. I go in waves depending on how busy and focused I am on things. I got board meetings coming up and stuff like that. So don't take it personal. We're getting better. I have some really cool stuff on the show coming. That's going to be stay safe, guys. Water, rice, and beans. We always have more in the room in the Midwest. Yeah, man, my mom has that in the Midwest. My problem is my wife has travel coming up because her birthday's on the 15th. And my wife is like my BFFFF. And, I can't imagine a world without like her there, and her traveling during this time freaks me out a little bit. Not only the delays from TSA at the airport, but just all this uncertainty. But I guess traveling to the Midwest is better than being out here right now, which is also weird. As for the show, we're going to do some stuff to aesthetically improve things in the show space here. Saeed and I... and Jill and I built the space. Saeed and I have been trying to tune it in for the last several months since we're moving in. There's always some improvements that are planned. We've got the teleprompter set up here, which you guys know about, and we're going to put a camera up there. You can't see it, which is also going to work as a panning kind of shot here that goes back and forth for a wider angle. Gives us a lot more of aesthetic, cinematic kind of vibe. I finally figured out how we're going to do that, wire it and keep it out of the way. We're going to add a little more sophistication to the programmed show that drops on Tuesdays. And then we're going to add some stuff to this show, depending on how things work out. There's a lot of people who use very similar chyrons and tickers and stuff like that down here. We want to actually use it in a meaningful way, and I've got some really cool ideas of how to do it and really present you valuable data that nobody else is doing. So stay with us. The evolution has been a bit of a slow one, only because it's really me programming everything, and Saeed and I have got families and responsibilities and all these other things going on, and Rajil is working his ass off. What's left of it, because he's lost a lot of it. Because he went to Fridays, entered the code HIGHER when he went to joinfridays.com and got $100 off his first order. And he is a client on GLP-1s. The man is literally skinny as hell. I mean, he's all sorts of bagging his clothes now, but he looks great. I'm telling you, Saeed, you might lose me at some point in time. That guy's a good-looking dude. All right. For those of you who tune into the show, I appreciate you. This will be permanently on X and on LinkedIn. We will take it down off of YouTube. If you do like it on YouTube, you say that link that you're watching it on YouTube with now, you can actually go back to the link at any point in time, even though it's not listed on the actual site. Rosie, we sincerely appreciate you tuning in all the time. It means a lot in the middle of the day, checking us out. I know that you love us, and we love you, okay? Till next time, everybody. As Saeed would say if he were here, okay, bye!